Hello everybody. Today's video is not for my usual audience. Today I want to explain how a normal vanilla classic venture capital fund works. The reason I'm making this video is that we have some new investors coming into the funds that didn't really understand how the venture capital fund works. If they put money in, how are they getting paid back? Like what triggers us paying them back and how does the whole thing work with 2 and 20. So I'm going to explain that. I'm also going to make a separate video where I explain how a venture capital fund of funds works. So this maybe is more relevant to people that are maybe doctor or lawyer thinking about investing in a VC fund, or you are an entrepreneur, you just want to bone up and make sure you have a full command of how this thing works, how the moving parts move, or if you're like a high school kid or undergrad or MBA, whatever. So let's say that you and I, my listener, are 50-50 partners and we decide to start a venture capital firm and raise a VC fund. We go out and raise limited partnership capital from typically many different investors. And so that means maybe you raise a $100 million fund with 10 investors. The investors are called limited partners. You and I, since we work here, we started the fund, we run it, we're called the general partners. So we're GPs, and the investors that put the cash into the fund that we invest into startups, they're the LPs, limited partners. And let's say we raise $100 million. Maybe it's 10 LPs, they're each at 10 million each. Maybe most of the LPs are at 10 million each or 50 million with one anchor LP. And we accepted smaller 200K checks that are paid in quarterly over 8 quarters. So over a 2-year period, our smallest LP is wiring $25,000 at the end of the quarter. So after 1 year, they've wired us $100,000. And after 2 years, they've wired the full $200,000. Maybe they invest in the next fund that we raise after this one. Or maybe that they just invest in that one fund, they're happy with that, and that's it. What ends up happening is that of the $100 million of paid in capital, which is the size of the fund, $100 million, we charge a 2% annual management fee. So we charge a 2% annual management fee at our fund, flat across 10 years. And so 2% times 10 equals 20. So that means 20% of the 100 million, and in this case, $20 million, is going to be spent on management fee. And the 80 million remaining money we call dry powder. We use that to invest in startups according to our strategy. So the 20 million of management fee is used to pay for accounting, where they make these things called K1s that we submit to our LPs every year in time for them to give to their accountant to file their tax returns. They get financial statements. There's other expenses like software and little LP events where we rent out a hotel where there's wine and food and beer and dinners and other expenses. So part of the $20 million is expenses to run the fund, and some of that is compensation. That's how we ultimately pay ourselves and associates. The people that work here full time are paid a salary. We also pay some referral fees to people that refer investment bankers and placement agents that introduce investors to the fund. Of the 80 million, that's dry powder. Typically that's diversified and we wire money buying stock in startups, and we invest. So you're hoping to invest in a Facebook and a Google and an NVIDIA early stage that makes a lot of money. So people ask, how do you get your money back? So they pay it in our case, in these capital calls over a 2-year period. Sometimes if they're coming in the final close, they might have to pay 100% upfront in one go. So they pay this 200K or 100K all at once. In some funds, accept smaller checks as small as $50,000. I've even seen smaller. And for some funds, they're saying, hey, our minimum is 25 million into this multi-billion-dollar fund. So how do you get your money back? Some people get confused with a hedge fund and a VC fund. And so that's one of the prime reasons to make this video recording, is explain that to you. So there's three ways in which in which an LP receives her money paid back to her from us. And that is when we sell shares in these startups. So we raise money, there is a bit of dry powder, and we invest all this cash buying stock in a diversified pool of different startups. In our case, roughly 25 to 35 startups in our direct fund. The three ways we get our money back is that they either have an IPO, so they go public and they list on a stock exchange like the NASDAQ or the New York Stock Exchange. And that typically takes years for the company, if we're investing early, to become big enough that they do an IPO, an initial public offering, and go public. And then the IPO itself will take at least 4 to 6 months after they decide to do it. And then there's often a 6-month lockup, and we're not allowed to sell our shares on the stock market at whatever the bid-ask price per share is at the time, until a 6-month lockup after the IPO. So it can literally take 7+ years for that to happen, even longer. So, and also the percentage of VC-backed companies that go public is a pretty small percentage. So you're pretty lucky if you have 1 or 2 IPOs in there. Sometimes, more commonly, the startup goes public on an alternative stock exchange like AIM, the alternative investment market, the daughter baby exchange under the LSE, London Stock Exchange, or the TMX in Toronto, or the ASX in Australia. But IPOs typically far between, not very many. The most common positive outcome for a venture-backed startup, in my experience and by the numbers, is mergers and acquisitions, M&A. This means that we fund a company, we do everything we can to grow it with ourselves and our network, and ultimately someone comes along and buys that company. It might be another startup that is still privately held, not listed on the stock exchange, and they buy that company, or it could be a publicly traded company like Facebook or Nvidia that acquires that company, or it could even be a private equity PE buyer who buys that company and they think they can turn it around or do something to it, roll it up and combine it with other companies, and ultimately sell it at a higher price. So M&A comes in different forms. Sometimes you sell the company in an all-cash acquisition, and we just receive cash, and we can immediately distribute that to our LPs. Or it comes in a mix of all kinds of stock and cash. It might take, multiple milestones and an earnout. Bottom line, M&A can be very simple, and we invested in the company. It gets acquired for cash, exit consideration, and we just wire that money directly to our LPs. Or we have multiple events where we're realizing cash and distributing that to our LPs. In some cases, if the company is acquired in an all-stock acquisition by, say, Amazon, and we receive stock in Amazon, we might ask our LPs, do you want me to distribute the Amazon shares because you believe that Amazon is going to go up in value, or do you want us to sell these shares on your behalf and distribute cash? So number 2 after IPO is M&A, very common. The third one is secondaries, and this is when somebody buys shares in a privately held company that is privately held and it's not publicly traded, but it's a secondary transaction, which means that the investor is buying the shares from us and we sell them the shares and we receive the cash and we distribute that cash to our LPs. A primary investment is when someone buys shares in the startup, where typically the startup is issuing stock to that investor and the cash from the investment goes into the treasury of the startup and it goes into their bank account and it's used for payroll and expenses and growing the business. So in a secondary, the money doesn't go to the startup to grow the business. It's just going to the owner of those shares. It could be that Mark Zuckerberg, as the founder of Facebook, sells shares to an investor that wanted to own shares in Facebook before it went public, and they couldn't buy the shares on the stock exchange because it hasn't gone public yet. It's not listed it's privately held. And Zuckerberg used that money to pay for a house in Hawaii or whatever he wants for private use. It didn't go to the company. The other case is a VC fund like ours says this company looks like it's going up in value. It's raising money at a higher valuation, like we invested at a $10 million valuation. Then we see the company raise money at a $100 million valuation. And investors invest in the company to fund the company. And there's still appetite from investors to buy more shares. And so we may decide we're going to sell 10% of our shares in that startup in a secondary. And when we receive that cash, we immediately distribute it to the LPs. So people have asked me, how do I get my money out from the fund? Well, we talked about how they invest in the fund with us either all at once or distributed over 8 quarterly equal payments typically. And when we realize cash from an IPO, surviving the lockup and selling shares on the stock exchange, or from M&A, and we're receiving exit consideration, hopefully cash, or we receive cash from the sale of shares to another investor on the secondary market. In all 3 instances, the money comes in and we immediately, or as soon as humanly possible, wire that money to all the LPs. So if we had 10 LPs that are each 10% of the $100 million fund, in this case, they are each 10 million in as investors, they would each get 10% of whatever cash is hitting our account. And we do that typically within a day or two of receiving the cash. So we cannot predict exactly when our companies are going to IPO, go through an M&A, and we have a little bit more control over selling some shares, maybe selling 10%, 50%. If it's been going on and we're ready to wind up the fund, we might even sell 100% of the shares we own in a privately held company. We might be selling shares at a higher share price than we invested at. We might be selling shares at a lower price. We might have raised $100 million and been fortunate enough that we exited $600 million. So the investors have gotten 6x their money. So someone who put in 10 million is receiving 60 million back. And we look at everything else we own and we say, let's sell it for 50% of the fair market value. Someone's willing to buy that. We're losing a little bit of money on some of those, but it's fine. We've already returned 6x. This final trade gets us to 7x and the fund is over. Typical VC funds have a 10-year term, and the general partner, the person running the fund, like me, in their sole discretion can extend the term of the fund by 1 year twice. So the fund is designed to start and finish within 10 years, and if we invested in Facebook and they're gonna IPO and it's gonna take another year, in my sole discretion, I can extend the term from 10 years to 11 and even from 11 to 12. Typically, if you want to keep the fund alive longer than 12 years, it requires LP consent. So we need to ask LPs if they want to vote to keep the fund open. For us, we're kind of motivated to shut it down after 10 or 12 years and not keep it alive. What's become after 12 years, what's become more fashionable or common these days is if for some reason there's some assets in there that were like Nvidia. For 10 years, it was just worth $3.5 billion. And now it's taking off to $5 trillion. And we're motivated to not shut the fund down. We typically say we're going to raise a CV, a continuity vehicle. And we say to all the LPs that are in the fund, we can either sell all the assets to the CV, the continuity vehicle, and this way you get distributed cash and you're done. Or you can recycle into the CV, and this is going to go on for longer. And that's a new vehicle that'll have a 3 to 5 year typical life, maybe even 10-year life. But this fund that you initially invested in is done and wound up. So that's basically it. VC funds have what people refer to as 2 and 20 economics, a 2% management fee times 10 years. That typically will add up to 20%. When the distributions come from M&A, IPO, and secondaries, in our case, we wire 100% of all exit consideration to the LPs until they get 100% of their paid-in capital. So they get their principal, the 80 million of dry powder, and they get the full management fee, the 20 million. It's almost like the management fee was a loan that we use to run the fund, and then we pay the loan back, as senior debt to the investor until they get their 100 million back. After they get their 100 million back, there's an 80-20 split, and the 20% of all the profit is called carry or carried interest or performance fee. And so we would raise the 100 million, we have 20 million in management fee, we invest 80 million. The first 100 million of exit consideration is immediately or as soon as possible distributed and wired to the LPs until they get their 100 million back. And then there's an 80-20 split of all exit consideration above and beyond the 100 million, if that were the size of the fund. The origin of the term carry or carried interest goes back to, I believe, the Phoenicians. Some people said the Venetians in ancient Venice, that when someone would have a boat and go all the way from China on the Silk Road, whatever, through all of this sailing the globe, and it finally makes it back to Genoa or Pisa or Venice or Phoenicia, when they unload the boat, the guys who had the boat and doing the trade get to keep 20% of what they carried. And I suppose that they're only doing that if it was profitable. In the world of venture capital, we get 20% of the profit as standard carry. Some VC funds get a little more complicated, and they charge a 2.5% management fee. And maybe after 5 years, it declines and it goes down by 0.5 percentage point every year or two. And net, the total amount of management fee is maybe 20% again, but it was front loaded. So they have more money in the beginning. And hopefully by year 3 or year 5, they've raised another fund. So now they're drawing management fee from 2 or 3 funds at the same time. Some will actually just charge a 2.5% fee or 3.5% fee. And so the amount of dry powder becomes much less than 80%. We're generally against doing that ourselves. We say keep it simple, 2% flat across 10 years, never less than 80% dry powder. Some VCs get fancy and say, we get 20% of the profit, but after we've hit a 2x or 3x, then we want 30% carry and 30% of the profit. And if you get 5x back, the VC GP is very greedy and says, I want 40% of all the profit, and it's a 40-60 split, which makes the thing a little bit less attractive. Sometimes, and final comment, and we're done here, is you'll see a hurdle. The fund manager, the GP, puts a hurdle rate in there. And this is where they're saying the LPs get 100% of their paid in capital back, the 100 million, plus LIBOR plus 2 or something. So maybe they get 6% interest on top of the 100 million. So maybe they get the first 106 million. And then after that, the next 6 million is paid to the GP. And then it's an 80-20 split where 20% of the profit is going to the GP. I personally just think the whole thing is a little complicated, and let's keep it simple. So most VCs as standard do not have a hurdle. It's something you see more in things like film finance and PE, where the LP was making a low return and they want to make sure I have a guaranteed return, which doesn't really exist as a guarantee, but they think I'm doing at least as well as if I left it in some sort of fixed income treasury bill 10-year term. And so for this long-term investment, I at least am under the impression and the perception that I'm going to, at a minimum, achieve the same return as I would have if I put the money into treasury bills, 10-year T-bills, and I have the option of hopefully doing even better. So that's it. The next video is going to talk about what a fund of funds is.